Okay, the Trump cycle, 2017, we've been talking about this. Trump came in, the markets reacted, same fear about tariffs, same thing, the dollar went up, everything else. And the same thing happened this time around. I mean, people are people. And what happened is the dollar ripped in the back end of 2016. It ripped in the back end of 2024. The dollar ripping is a tightening of financial conditions that play through markets and the economy 3 months later, which is why we had the correction in the first quarter. We showed you all of this as part of the M2 thing. Anyway, we said it at the time. We've been tracking this before the dollar topped out and said, he's going to go for a weak dollar. They said they want a weak dollar, and fuck me, the dollar's been weak. It's been an extraordinary weakness. Now, this is not some structural, ever-ending weakness. That'll come at some point when we change the rules of the game. Right now, cyclical weakness being pushed by Trump and Bessons, and it will continue to do so. And that is an amazing tailwind for markets and risk. Bonds, everyone's like, oh my God, bond yields, every time they go up, they're going to break out, they're going to go 6%. All the drama of the macro people. It's like last time, bonds were in a range for Trump. They'll probably be in a range for Trump this time. He'll get the front end lower and the yield curve will steepen. He will force the front end lower by changing the Fed chair, etc. And so bond yields are really not a big deal for this equation. So let's not worry about that shit. That's the macro doomers.
Raoul Pal talks Bitcoin and crypto. Discover market trends, future predictions, and smart moves. Let's dive in and learn together.
Look, from our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID. Exactly the same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now, where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Before they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. All the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job, it's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only 2 assets that outperform this. One is tech stocks, and the other is crypto.
Bitcoin is kicking off the final week of July with strong momentum, riding the wave of what's being called the biggest trade deal ever, with the United States sealing a major agreement with the EU and Japan and putting tariffs on hold with China. Risk assets like Bitcoin and the stock market saw immediate gains. The S&P 500 opened at a record high, and Bitcoin surged to nearly $12,000. Although that level didn't hold, BTC still sits comfortably near $19,000, giving bulls hope that all-time highs could soon be back on the table. Traders are watching closely. Some analysts believe that if Bitcoin stays above $117,000, it could ignite another leg up, but the threat of a pullback to $113,000 remains. Meanwhile, macroeconomic pressure is building with a jam-packed week ahead. GDP data, the Fed's interest rate decision, and the PCE inflation index are all coming. Raoul Pal is in the hot seat, with traders looking for any hint of a future rate cut. Adding to the uncertainty, Bitcoin's upward momentum may be stalling due to stablecoin liquidity drying up. On-chain data shows fewer stablecoins entering the market, meaning less buying fuel. Without new liquidity, Bitcoin could cool off, at least temporarily. The bulls might need to wait just a bit longer.
And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed. Is what had happened was all of this. Now, what is driving this? And I think, Julian, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US, much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics of destiny. They are. Until the AI and the robots come, which are basically artificial humans, this is the problem that faces us all. But there's a way that they've got around this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. And this is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement, by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters.
XRP is making waves again, climbing above $3.20 and stirring excitement that a $4 breakout might be just around the corner. After recovering from last week's sharp sell-off triggered by Ripple co-founder Chris Larsen offloading 50 billion XRP, the market bounced back quickly. Traders adjusted and whales began accumulating even more. According to Sentiment, large holders with balances between 10 and 100 million XRP now control over 8.3 billion coins, a monthly high. That kind of accumulation often signals bullish sentiment and can help set a strong price floor. New wallet activity on the XRP ledger also supports the bullish case. With over 11,000 new addresses created in a single day last week and a daily average of around 7,500, interest in XRP is clearly growing. This increase in network activity is one of the factors helping XRP outperform Bitcoin over the past month. To hit $4, though, XRP must hold above key support zones. Analysts are watching $3 closely, with $2.95 seen as the must-hold level. If the price stays strong and volume increases, targets around $3.80 to $4.47 become possible. Many believe XRP is now entering the most profitable phase of its bull cycle. With strong fundamentals and big traders backing it, XRP could be heading into a powerful breakout. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoinzilla for daily news, all for free. That's all for today's video. Until next time.